It's Brian Preston, the money guy.
Okay, this is a good one. This is from Debers for Life. My wife's employer and mine are offering an HSA, health savings account, but the premium is so much higher than the regular health insurance. Would it still be a good idea to do the HSA? Because I hear you guys talk about it being triple tax advantaged. If I have an HSA, should I always, no matter what, do the HSA option? I added that last part.
That's a great question. And the fact that kind of surprises me, though, the way that question is structured, because I'm not so sure that the employer is doing it the right way. Because, look, to even have a health savings account, and they are triple tax advantage, they're super powerful for saving for the future. There's even opportunity to get some tax-free growth there. But they first need to go through a filter because you can't even have a health savings account unless you have a high deductible health insurance plan. So that means the employer, for this person who's asking the question, does have an option within their health insurance, cafeteria plan for a high deductible plan, but it's a little contrary to what I'm used to, because the problem, or I guess the thing you need to be aware of with high deductible plans is they have much higher out-of-pocket limits, meaning the deductible is going to be higher, your maximum exposure financially to your family is going to be higher. That typically, because you're not getting the Cadillac benefit of the copays and some of the other things that you have with your traditional insurance, means that you have lower premium payments. Because that's why I like, high deductible plans, with the HSA attached to it, is because, you're typically supposed to save a few $100s a month that then you could, in theory, throw towards the health savings account. And if you're healthy and not using medical care, especially if you're a younger person and you don't have a lot of medical expenses going on, you get the protection, the coverage, but then when you don't actually use medical services for a year or two, that money, the savings of the insurance premium, can actually be going into the health savings account and building your army of dollar bills. So to hear that your high deductible option is actually more expensive than traditional lower cost insurance, I'm scratching my head a little bit on that.
Different, yeah.
Because that doesn't pass the test of what these were designed for. Remember, they're designed for you're taking on more of the exposure. Because you're taking on more of that risk or exposure, you're getting lower monthly premiums. The savings from those monthly premiums are supposed to be deployed for future needs, and that's in the health savings account. This seems a little contrary to that.
Now, some employers do have what we call Cadillac insurance plans, where they're like really, really, really good insurance plans, and some employers highly subsidize those. So it's not unlikely for you to have a health insurance option with really good coverage and really low out-of-pocket costs and great copays and all this stuff, and they highly subsidize it, but then you also have this high deductible option. And so we get people ask us all the time, well, I've got the HSA, should I do that? Not always. I mean, it's basically a mathematical calculation you have to run to say, okay, what's the premium cost difference? What's my estimated health cost out of pocket difference? And then what's the tax deduction difference? And you add up those three components and you figure out which one is more advantageous for your circumstance. And what I think is surprising to a lot of folks is it can change year to year. If you're going into a year where you think maybe we're going to have a baby next year, there's going to be a major surgery or some type of thing, one of those health insurance policies might make more sense than the other. So it's something that we encourage everyone to think about on a year-by-year basis when open enrollment comes up.
If I was pontificating about what's actually going on with this individual, I wouldn't be surprised if the legacy insurance is heavily subsidized, because that's where the majority of the employees are, and they have a lot of legacy employees that have been on the health insurance for a long time, so they've highly subsidized that part of it. But then they had enough employees that watched the Money Guy show and other things that said, hey, you need to give us an HSA option, high deductible plan, so we can do HSAs. So the employer, said, hey, we'll bolt on this opportunity on here. We'll do a high deductible choice. It's not going to be as heavily subsidized by us. It'll be a win-win for the employer, because maybe people will go into this high deductible plan for the HSA. We won't subsidize it as much. There's got to be something like that going on. That's why I think it's a great question, because you first got to go through the gauntlet of the filter of what's the best health insurance for your family. And then if it turns out to be that you don't use the insurance, you don't need the medical expenses or other things, make sure it's a cost savings so then you can invest in that health savings account. This doesn't pass that test.